Good afternoon, everybody, and welcome back to Schwab Coaching. Our next topic is trading breakout patterns, and I am your host, Kevin Horner. Thank you to all of you for joining me today. Plenty to get to. I've got a number of new example charts that we're going to check out in various stages of differing breakout opportunities. We're going to look at a few of those, get to a couple example trades in the account today, and review some example portfolio positions that need to be addressed as we approach expiration for some option positions, as it turns out. So plenty to get to. I am so glad you are all here. I see a lot of familiar names in chat, names that I've been able to put some faces to of late. I'm very excited for that. Thank you guys for not just going to the events, but obviously hooking up with our coaches that made the event as well, and love to see your faces. So thanks for being here, and thanks for participating in all the external stuff we're trying to do for you guys. It's obviously a big part of our overall trader offering. Say hi to my friend Barb Armstrong in the chat, who's going to manage things there for me today, get to questions that I'm unable to get to. But I'm going to try and keep an eye on things and engage with you all as we work through the segment here today. I already see some questions about it, so we will address it. Yeah, let's talk about the upcoming schedule. This is the last of the Trading Breakouts classes because we fall, of course, on a Wednesday. Next Wednesday is Christmas. Wednesday thereafter is New Year's. And I'm going to just go ahead and highlight this for you all. I'll pull up the calendar so that you can see what's happening here. I'm going to the schwab.com coaching page, everybody. And under live webcasts and virtual webcasts, of course, if we just scroll down, you'll see that beginning with the half day as we follow the market schedule next Tuesday, Christmas Eve, we'll be only hosting the half day sessions. And then we are dark until we get back to business on the 2nd in January. Now, this class in particular has been combined. It will become trading patterns in lieu of trading breakouts or trading flags specifically. Our friend Barb in chat will be the host. And so if you'd like to check that out, come down to Barbara Armstrong and you can move forward here on the month into January, and you'll see this is the class we're looking at. So it is trading price patterns. It is still going to be on a Wednesday, and it is still going to be at 1 p.m. Eastern. So that'll incorporate equities, it'll incorporate options, and it'll incorporate various patterns for conversation. So a great class as we turn the page to 2025. Just wanted to make sure that you are all aware of that. And then finally, don't forget about the in-person events, guys. We are continuing to get the signups updated. We'll be out in San Diego in early January, I should say. In fact, I'll be going out for that one. I'm very excited. We're going to have one in Seattle the end of January as well. You can see the register button just popped up. So y'all are able to get squared away for that one. Please do exactly that. All right, so now, of course, I need to get to my standard stuff. Let me remind you all that our conversation here is exclusively informational and educational. We do not make recommendations nor endorsement for any particular strategy or approach to trading. Remember that options carry a higher level of risk and are not appropriate for all of us as investors. You do need to be approved in order to trade options at Schwab. You need to do that on each individual account on which you would like to trade options. And you can have varying levels of option authorities between those individual accounts. Remember also, we work in a paper money version of the Thinkorswim desktop application. And in trading options, selling options specifically, in the paper money version, you will not be assigned early on any option position you are short. However, in real life, this can absolutely happen. So when you are working in a live account, selling options, whether calls or puts, you can have those contracts put to you, or you can be assigned, I should say, taking on shares or selling shares. And it can happen even ahead of expiration. It can also happen even if your contract is not in the money. Be aware of those details. Now today, as we work through some of this stuff, we'll also just consider some of these additional details associated with options. Of course, I always got to highlight past performance of any security or strategy. It never guarantees our future results. We all know that one pretty well, don't we? So as usual, we'll kick off with a market overview, very brief. I'm going to hit up the SPX and the NDX quickly. We are, of course, about an hour ahead of the today's FOMC decision, which could very well have market impact. So we'll look at that and get to some new trade examples and then trade management of the existing example portfolio. And again, like I said, I've got some contracts that are squared away to expire this week and next week. So we're going to go ahead and get to those and talk about that process as well. So as you can see, it's a full agenda today, everyone. Let's start out with a quick look and kick this back to the SPX. We are up on the day. You know, when we spoke in Trader Talk, we were talking about the potential to maintain and hold that 20-day moving average. We have done just that today. We have moved through the high of yesterday, and the only question becomes, are we going to hold? Right? As I said, we got that decision coming in about an hour, followed by some commentary, testimony out of Fed Chair Powell that could have maybe a heavier weight to today as opposed to the actual decision itself. And I say that simply because the expectation is very, very high, 97% likelihood, according to the traders' positioning on this, of a 25 basis point cut coming today. Now, the commentary could be hawkish in nature. It could be stated, for example, that the Fed does not see X number of cuts coming in next year in 2025. Maybe they feel that they need to take a pause. These are the things that might hinder the market a little bit. So it's important that we pay attention and set our levels and know where we would like to move on from any of our individual trades here. Everybody always be cognizant and aware of how your positions could be impacted by shifts in the market. And a day like today, an FOMC decision day, is one of the few remaining catalysts in the market here between now and the end of the year. Quick look at the NASDAQ is going to show us more of the same. That little bull flag 2-day event that I was mentioning in Trader Talk this morning continues to hold, basically flat on the day here at 0.03%. So just a little sideways and not a whole lot of action ahead of the announcement today. All right, so I do have a couple of charts that we're going to look through. Like I said, in varying instances or points in differing types of breakouts. One that we're going to start with, but we're going to look at Boeing. And the reason we're going to look at Boeing, and if we just pull this back and change this chart to maybe 3 years, capturing maybe the majority of this downward move, and this wasn't the only one, of course. This was just from December of last year, taking us into this year. So it's obviously been a pretty rough ride, according to my trend line here, down by about 45% to this point. And if I redrew and maybe activated it to the bottom, we're going to be looking at a peak to trough move of about 48% lower. Not a great move, right? And if I added a little bit more time, let's go to 5 years, we can see that we've even been higher, right? And we can go a little longer than that, and let's make it 10. And then we're going to capture even bigger levels that we have fallen from and have not really come back to, as you can see. So why are we bringing this one to the table today? Well, I wanted to talk about it briefly because if I put my line where it was originally, I want to just talk about a short-term scenario whereby a trader might have said, you know what? I am actually seeing improving conditions, and I may feel comfortable starting out a new position. And that might have occurred with the break of this downtrend line in here. And it might not have been immediate, right? So let's just pay attention to that. We're at 267 up here. Down here, we're hanging out at our low of 137. I'll zoom in to just about the last 5 months and take a peek at this initial little break of the downtrend line. Now, we talk about this from time to time, don't we? The idea that you can be an aggressive trader and you might start a new upside position with the break of the downtrend. Some would call this 3-day action a breakout because you have broken what had been in place for an extended period of time. And in this case, that extended period takes us back to December of last year. So we're basically looking at a 1-year downtrend that may, at this time within my bubble, may have been corrected. And so an aggressive trader might start there, right? They might say, that's an interesting note. I'm going to start putting a little money to work. Maybe it's because we had 3 days of holding the breakout that gave them reason to believe in it, and they started a position. Maybe it was 25% of what they ultimately wanted. Maybe it was only 10, but they probably looked at it and said, well, all right, if we've got something new developing, then I'm going to have layers where I'm going to feel even more confident. Where's the next layer, everybody? I bet you can all see it, right? Next layer, I'm going to put an arrow on it. How about that one right there at my red trend line? Let's, I put that up there as resistance originally. I'm going to change this up a little bit. Put that arrow like so, right there, right? 160. So 160 may have become an add to the trade scenario, whereby the trader says, all right, I'm in 25%. Now we've moved through resistance with a lovely candle on that day. Maybe now that trader goes, all right, let's add another 25%. Now I'm long 50% of the position that I want, and I am profitable from about, say, 155. And we've got now two separate positions at 155 and maybe 160 to 65, and we can still keep rolling with it. Hopefully that trader that stepped in has been raising their stop exits along the way, right? Working against some sort of momentum-based scenario where they say, you know what, if we got thrown back maybe below that very important 200-day moving average, maybe then I would move on from my trade, but they're going to have a plan in place, right? So I just wanted to point this out because now we've made one move, consolidate very quickly, made another move into resistance. Notice the tails. Look at that even closer, everyone. Sorry about that. Let's fix that. Look at the one tail, two tails, three tails, four tails, trying to get into and through resistance at 160. Couldn't do it until we did it. And then once we did it, now we've got momentum going to the upside, right? So an excellent continuation. Very basic, but I bring it up because, again, I want to remind you of what can occur and how the steps that a trader lays out for themselves along the way, that what I like to call the playbook, right? The playbook that is your ideas and thoughts and comfort for adding positions, starting positions, continuing, raising stops, etc. All of that stuff needs to be in your playbook for an easy and quick reference so that when this occurs live and in the moment, you are ready to do what you need to be doing, right? Now, today's action doesn't guarantee anything. Yes, it's a continuation. Yes, it's a new high at 177. Maybe the trader that bought back here at 155 is more than pleased and taking their 10% trade off the table today. That's a possibility. I don't know how anyone who's been buying this is going to manage it. I just know that's important that they do, right? That's what we're looking for from this conversation. So that was my takeaway on Boeing today. I wanted to make sure, again, because largely it's one we haven't looked at in a while. And two, we have had a series of shifting trend opportunities here in the short run. Quickly, if you look at from the low at 137 to where we are today, stock is going to be up about 40 points. According to the easy math on that, that's nearly 30%. An excellent, excellent return. All right, moving on. Next up on my varying stages and potential breakouts, what about Lululemon? Great little pop to the upside. It looks like this has occurred. Whoops, sorry, everybody. Looks like this occurred with the earnings window back here, right? So that seems to be the reason for this nice flagpole up. And we are simply flagging right now. I'm bringing this one up, everybody, because quite simply, we don't have any action point just yet, do we? Have we broken the downtrend line one way or the other? Have we held the gap high or the gap low, pardon me? This is certainly an area whereby somebody who bought it back here, got the gap, participated in the upside, they might be looking at this zone for support, and they may have a stop exit on long shares acquired back here. They might be doing that somewhere underneath this by some measure to hopefully stick with the position. But if you're a new trader, new traders are probably just sitting on their hands because we're building this cloth portion of the flag here. So reminder, for trading breakouts, what do we wait for? We wait for the breakout. And then when the breakout's there, then we take the trade. We don't have a breakout yet, so Lulu is a wait and see, a potential watch list trade for us all. But for now, that's where it resides. If we get a close above the trend line, like we saw, and again, this is just 101 stuff, right? We were exiting on Boeing, a lengthy downtrend. We broke the trend line, consolidated for 2 days before we continued higher. That became an opportunistic signal that some might be ready to rock and roll. Well, here, this is now continuation opportunity. The same thing can be said. An aggressive trader might choose to buy the day it closes above the trend line, and recognize that if you're that aggressive trader, you cannot assume it's going to just immediately start crushing higher, right? It might take some time, but the signal that it gets outside of that downtrend line is the key component to trading the breakout in that case. Daniel, good question. Kevin, how long does a new trend need to be in place before it to be considered a flag pattern in a new direction? The truth is, it doesn't need much time. I mean, in our case with Boeing, I'll just quickly go back. This was 3 days, Daniel. I mean, look, let me remove that line. And this looks like a bull flag, doesn't it? A bull flag having broken a downtrend. It was at the 50-day. A bearish trader could have absolutely told themselves a story that says that might be a bull flag in nature, but we're at the 50-day. We're at resistance. Why am I going to be optimistic about a stock that's been in a 1-year-long downtrend? You might not have been. My point is simple. I didn't know that was the way it was going to go. I pulled the chart up today. I'm sure there were traders on the bull side and the bear side that could have told themselves this could go either way. And look, it happened to break to the upside this time. That's all I can say about that. So sometimes it can be as quick as 2 to 3 days. Sometimes it might take longer. We just don't know. There are many other components that fit into the conversation 100% of the time. So we cannot assume that our technical breakdown is ever going to be the same from stock A to stock B, or from Boeing to Lulu, as an example, right? Because everything else carries as much weight as anything, right? The group in which they reside, not just the trend that it came into with, but what is the narrative around all of that stuff? For a long time, the narrative around Boeing has been rough. So bears would have been forgiven for denying this pattern for the last month plus. All right, how about some where we can potentially place new trades here? Let's take a look at Roku. All right, so Roku here has made a move to the upside and may very well be setting up in a price pattern that you all are familiar with. Why don't you go ahead and throw it in the chat for me, everybody? I know you all know what I'm looking at here. So put it in there. Let me know what you think it is. I'll go ahead and draw it in. The interesting thing is that we did get this pop to the upside, not an earnings or anything like that, but we popped to the upside through an area of potential short-term support, short-term resistance, now potential short-term support, right? So let's just change this so it looks that way. And then over the last 2 weeks, we've just been consolidating in what could be a flag, cloth portion of the flag. And I'll just draw my pole down to the bottom here to estimate an approximate height of that flag. So we got a couple things for us to pay attention to. That's right, BJ, bull flag, absolutely right. And what is it about this that stands out more? Is the fact, that we have this ledge of support coincident with the gap low. So we had a nice gap move. We got through resistance on the gap, and that becomes potentially, a point under which a bull trader would be a little discouraged, right? Maybe not terribly confident. Now, we have a flag pole. We have a cloth flag. Is this trade ready to be taken right now when you look at this? I'll go ahead and give you guys a few minutes. I'm going to give you 30 seconds as I chat this through, but tell me in the chat, do you think that this is a trade that a disciplined breakout trader takes at this moment in time? Okay, that's what the real question is. So we have a potential for, let's see, this is about a 20-point move from 66 to 86. All right, here's what I'm seeing. BJ says not yet. Paul, no. You guys have been here a while, haven't you? You guys have been coming to this class. You are all ready to move on. I love it. Terrific. Excellent. Thank you all. All showing patience and allowing a breakout to occur. So we need a trade through our downtrend line before we can get that, right? So sitting on our hands, what about a trade that we could place today that would get us into that scenario if we wanted to buy on a breakout? So maybe we go with something like a buy stop order as a potential way of looking at it. David, you're right. The volume is low. The low volume as we consolidate and form the flag is actually a nice positive. It means that anybody that's been buying it up in advance of the breakout has not been selling it, have they? Which is why we've seen higher lows and price action more or less going sideways. And Ranjit, that's exactly what we're thinking about. Why not a breakout or a conditional trade? So let's talk about that. Our options are many. Some would consider a close above the trend line. So let's say 85 becomes our level. So I'm just going to put a line at 85. And if we traded through 85, some traders would say that's where I'm going to buy. All right. And so some would sit on their hands, as you might do. You might be watching the market each day, tick by tick, live, and you might want to buy it when it gets to 85 and you might feel good about it. But that might be aggressive on an intraday move, everybody. So consider that you could be the trader who says it has to close above 85 and then I'll take a long position, right? Some traders would say, I'm going to let it close above 85 and then I'm going to wait a day or two and see. Some traders might also say, I'm going to let it close above 85. I'm going to take 25% of my trade and I'm going to see what happens. Okay, I'm going to protect my downside with an exit strategy should it break down on that 25% of my trade, but I'm still going to look to add. Now the question, where do we add, right? So is it at the, if we trade above 85 on day 2 or something like that, I think a lot of traders would just take and duplicate this line and say, you know what, instead, let's break through to a new closing high over the highs we've already made in the flagpole. And then that might be a spot where they would add to that position. Okay. Now, some of you would say, I'd like to automate this. I would like to do that with a buy stop order. Okay. Which we can do. We can do a buy stop. So, a buy stop is just as risky as a sell stop because it does not, in the traditional buy stop, does not guarantee any price, of course. So when you place your trigger on a buy stop, in our example, maybe the trigger is 85, you could be a buyer much higher than that with the standard buy stop order, because once triggered, it becomes a market order for purchase. So we have that gap risk that we need to be aware of, right? So here's how that might look. Let's make this just a small 25 share position. We'll make this a standard stop, good till cancel at 85. Now the risk here is a couple things, right? One of the risks is that we trade above 85 intraday, but we don't hold it on our close. That's a little tricky for the buy stop trader who believes a breakout is imminent. If you buy it at 85 and it closes at 83, you're not going to be feeling as warm and fuzzy, are you? So needless to say, I hope it's needless to say, you may wish to incorporate your exit strategy as part of your purchase on a buy stop. Alternative 2 is to change this to a stop limit where you set 2 prices, our trigger at 85, and then instead of a market order to buy, you say, I want to buy it when it closes, or excuse me, when it trades through 85. But in order to reduce the gap scenario risk, let's revisit what that is. We closed at 84, but instead of opening tomorrow near 84, 85, we open at 90. Okay. If we open at 90 with our standard buy stop order, we're going to get execution with a market order pretty close to 90. But if we change this to a buy stop limit and set a limit at 86, well, then we know it has to trade through 85 to trigger. And then we will only buy if we can do so for 86 or less. And if it only offers us 86.01 or higher, we don't get put into the trade. Okay. Some of you might not like that. Some of you might prefer to be put into the trade automatically. That's that buy stop traditional order with a market execution. Okay, got to bear that in mind. Remember, as we often say about sell stops, the same concept holds. They are not perfect. There are issues or things you need to be aware of and conceive of, but as long as you build that into your process, you should be all right. Okay. All right. So that's one option as well. Now, the third option is to simply allow the position to do what it's going to do, and you put yourself into the trade after you've defined a close over your breakout. So you can absolutely do that, or you could, of course, decide, let me change this back to a traditional stop with a market once triggered. And you can use this little gear, and you could tell the platform, I only want to do this if it occurs in the final 5 minutes of trading, as an example. So maybe you set your time frame like this at 3:55 p.m. Eastern. Remember to use Eastern and use military time. And you can basically say on this date or any date into the future, and then set the time frame. This way, you are increasing the likelihood of being above your ledge on close. You could even make this the final minute of trading if you preferred, right? So conceive of that as well. Incorporate other conditions that could give you a better opportunity for the trade, or at least a trade that's going to make you feel a little bit more confident if that's what you'd like. Okay, so wanted to bring that one up as well. Let's go ahead and do a standard buy stop that I'll just put on for myself, just so we can see how this looks in terms of placing the trade. So let me eliminate some lines, and then I'm going to go in and when we place this, you're going to see the order show up. There we go. And we have it ready to go. So now we got to trade through 85, and then we'll get execution. Okay. So there we are. There's your Roku example opportunity. No execution at this point, but that's because we haven't broken out. All right. Next up, how about one that I came across this morning? CME Group. This one looks a little different, doesn't it? Like maybe this one is in the process of breaking. Maybe not. Maybe the trader's feeling a little bit good about the fact that we've held the 20-day, and while we are trading at the high of the day, some traders would say this is a visual reflection of a breakout that might be pending. That could be certainly a possibility. Doesn't mean it's right, just means it's a possibility, right? So let's look at our levels here, everybody. Let's evaluate quickly, and let's see about placing. How about, let's see, this is a potential continuation pattern. What about a long call vertical on this one, where we pick up contracts that are maybe lower than our support level so that we can get more bang for our buck? And I'll explain that. And then maybe we target the potential to make a new high. So here we're trading at 238, 239, and we have last high at 249. So if we said maybe 250 for our exit strategy, maybe we could do a long call vertical where we do, let's see, the 50-day is down here at 229. So what about like a 230 long call and a 250 short call? That would give us a $15 strike spread to work with. And then we could potentially take a profit scenario if we could trade through 250 to the upside. Once more, good point, Andy. Not much volume of late, but why? Well, we had a huge volume day in the midst of the explosion to the upside. So what do we take from the volume dying off? We take that traders that bought into the trend haven't sold this down aggressively. They've simply allowed this to retreat to an area that could be deemed short-term support around 234. So in terms of overall volume, you know, we average, or today we've traded just shy of 600,000. If I was going to ballpark that, probably means better than or close to 1 million on average a day, just as a thought. And you know what? I think from a standard of, trading, you want to make sure you've got enough liquidity. Surely one of the keys that a lot of traders work with is to set volume limitations. So average volume greater than X in terms of scanning the market does make a lot of sense. Commonly, I think the traders with whom I've spoken with historically kind of lean into volume in the neighborhood of 500,000 to 700,000 could easily be enough to work with from a liquidity standpoint. Remember, our key in looking at volume as much as anything is to ensure that whatever we buy, we can exit. Okay, that's a big deal. Now, when we're talking options, that's a much less big deal per se, because the option contract that you are putting yourself into always has another end to your contract. By definition, it's a contract, right? So good point here, Ranjit. That's actually excellent. Great for bringing that up. So the stock is going to go ex-dividend here on 12/27, and that is for $5.80. There will be an option pricing adjustment as a result of that. The stock itself will adjust by $5.80 for those shareholders who are going to be earning that dividend. The stock is going ex-dividend on the 27th, so 9 days out, the stock will be trading without that dividend. And so that might be a key component that some traders want to avoid. You're absolutely right. Okay, now we're going to put on the trade as a means of an example, but I'm glad you brought that up, Ranjit. That is an excellent point, because utilizing and being aware that a stock is due to pay a dividend can give you greater likelihood of being assigned if you are a seller of an option. Okay, now as a long side holder, maybe a little less of an issue. However, it's certainly something to be aware of. Now, in our example, looking at the 230 ledge and 250, I said 230 and 250. I should have done the math on that. That's actually 20 points, Kev, not 15. But the point is, we could totally build a potentially upside bullish scenario. Let's look at our contracts in here. We're going to go not to this Friday, but we'll go to January. And let's just look at that 230 call for January, 9 points. Boy, that 250, not a lot of volume of action there, huh? Not going to save myself a whole lot by selling the 250. I'm only going to bring in $60. So that's not going to help me reduce the cost of my entrance all that much. Maybe we change this to a $10 wide spread instead. What is interesting about this, let's just quickly point this out. The 230 contract has a delta of 82 cents. So real briefly, let's just remind ourselves what the 80-cent delta means. An 80-cent delta tells us that we can expect approximately this contract to go up 80 cents as the CME underlying stock goes up $1. So you are getting 80 cents on the dollar to the upside for the long call. Okay. So if this were to jump up the 10 points, we would expect about an 8-point move, $8 in the value of this contract. So we might have to pay not in between these two, right? Say $9.75 for the contract. And if it went up 8, maybe we could sell it for about 16 or so, 16, 17, something like that, right? So that's one way to look at that. And of course, the delta here at the 240 is only 43 cents. So this one is not going to go up nearly as much, okay? But our goal with a long call vertical is commonly to be trading at expiration through or higher than the second strike, the short strike price, because we want to make the difference between those two over the course of the trade. So here, 43 cent delta also means a 43-cent likelihood of being in the money at expiration, or 43% likelihood. So there's, generally speaking, two ways that a trader might consider delta. Price action on the contract relative to a $1 move in the stock, and the potential likelihood, if you will, that the specific contract is in the money at expiration specifically. Okay. So in this case, if we were to do a long call vertical, buying this one, I'm going to hit the control button on this and sell the 240 instead of the 250. That leaves us with a $10 spread. It's going to cost about let's round that to an even number, 675. And remember, the quick math says if my spread is $10, I can make that $10 in the trade minus my cost. So $10 minus 675 means that my max gain on this, if I hold it to expiration and the stock closes over 240, would give me 325 in max profit. And that's laid out here. Okay, so yes, my cost would be 675. Again, max profit at 325. But if you're bullish in nature, that's what you're looking at. And I've got some examples here. Let's go ahead and send that one off, everybody. Got that to execute. I got some example positions that we are going to use to further this conversation. Let's check out my option positions we've got here. Now, Flutter is a wonderful example of how, and again, I'm going to say it, I got to point out, it's an example, nothing more. But it's a wonderful example because of what we have been allowed to do by virtue of the long call and the short call. We have held this contract longer than we necessarily needed to. But let's look at what has occurred when we do that. So we've got the 240 and 270 strikes, and we applied them, put the trade on November 13, right here. Okay, so let's go back to the chart. November 13 is right about here. We bought it on the gap day. Okay, so we bought a 240, 270 long call vertical spread on that day. And the stock crushed through 270 and traded as high as 284. And weeks ago, 2 weeks back, we looked at this and said, Kev, should we close this out? Can we close it out? Well, we didn't have to, and we didn't. But what has occurred here is that while we have maintained our levels in price, the value of our overall position, our net profit, has also held up, because while we've given back a little on our 240 call, the 270 call has dropped pretty dramatically in price. And now we are profiting on both of those contracts. The time erosion has benefited us in on the 270 call in a fantastic way. And it's enabled us to pick up a few extra dollars simply because the stock didn't continue crushing to the upside, right? So now we are nearer the 270 strike. The stock is hanging out at just above 273. And so we can go ahead and close this one out for $895 of profit, which we're just going to take the opportunity to do right here. So I'm just going to right click, create closing order, sell one vertical, 2830 limit. Sounds good to me. Some of you might just say, I'll take market order, but I'm going to encourage limit nonetheless. We'll go ahead and hit confirm and send and get us out of that one for profit. And sure enough, we are moving on. So that one worked out favorably, even for our willingness to just let that trade go. Remember, you can close it, assuming that both legs remain open, you can absolutely close it. But we chose to hold, see if we could get some of that time value out of the short call, and it worked out that way. And so the short call profited for us and the long call profited for us as well. So worked out favorably. All right, next up, we've got, after Flutter, I put on a position. Let me check my timeline here. Next was the Netflix position. So we've got a long call vertical, $10 spread only on this one, also expiring this Friday. This is another one that has popped in our favor, of course. Notice the long call itself, the 885 long calls worked out wonderfully. But because we are short the 895 and trading through that by 20 plus points, okay, we are in a loss on it. But we have 420 of profit associated with the trade collectively. So this trade has absolutely worked out the way that we had hoped. And I'll remind you about the thought process briefly in building these long call verticals. Yes, by putting the cap on the short with the short calls, we are capping our trade upside, but we are also reducing our risk. And so not every trader is going to be comfortable with the spreads because they don't want to give up that upside opportunity. It's clear to see in hindsight, had we just simply bought the call, it would have cost us, the $2,500 and we'd be up $1,000. That would have been fine too. But we would, in this scenario, it cost us less to put on because we sold the 895 at the same time. So we had less risk, and we admitted that we were happy to take some profit rather than no profit. And that's what we put ourselves in position for here. Okay. So in this case, we are 25 points through our short side. With only 2 days to go, it's unlikely. I mean, it's certainly a possibility. It's just unlikely that we're going to have a better opportunity to profit more than we do right now, given the limited amount of time that remains. So we'll go ahead and close this one as well. Again, this is just coming to the highlighted comment, the actual strategy. Right click, create closing, and sell one vertical. Now you can choose to leg out by simply buying back the short call, for example, if you think there's more upside over the next 2 days. But remember, if you're looking to trade the close or close out the position in its entirety, just sell one vertical. We will do that at the current 920 limit. We'll take that 922, confirm, and send. Okay. So I think that's it, everybody. I mean, in the portfolio, plenty more to look at, but unfortunately, we just don't have the time to devote to it. So I don't want to step on anyone's toes as we go forward to our next segment, but I do want to answer David's question about how the option adjusts for the dividend. Well, remember, the option most often does not make an adjustment for the dividend. The price of the equity makes an adjustment for the dividend. And that can have a bearing on the underlying price action for the stock or for the option specifically. In this case of CME, if I was just going to give you an example, we got that 580 coming on 12/27. Let's just assume we get a close at 250 per share on the 26th, the day before X dividend. So that's what we highlight here in Thinkorswim, everyone. The date of the dividend is not the pay date. It's the X dividend date. Why is that? X dividend means the stock is trading without its dividend. X equals without. Okay, I'll say that again. X equals without. That means that on December 27, the stock is trading without its dividend. Anyone buying on December 27 or thereafter does not earn that $5.80. So on the conclusion of business on the 26th, if we closed at 250 a share, the stock's price is going to be reduced by the amount of that dividend, $5.80. So in reality, the close is actually 244.20 in my example on the 26th. Okay. And that's because everybody that held CME through the close of business on the 26th, you are getting that $5.80 in the form of a cash dividend. How you choose to handle that is yours, right? You can either reinvest it if they allow it. You can take that in the form of cash. But everybody that buys it the next day, they aren't entitled that dividend, right? So they have to buy it, and they get to buy it, at the reduced rate. Whereas all of us who held it through the ex-dividend date or into the ex-dividend date, we're going to get that 580 given back to us. That's why the adjustment lowered. Now, we never see those adjustments, okay? It's simply the next day when the market opens, all of the trade activity will be taking into account the value of the stock based on the dividend having been paid out or having gone ex-dividend in the stock, okay? So the next day, price action is going to be normal, we would say. But sometimes you might notice this kind of movement, especially in a stock. This is a pretty healthy dividend. $5.80 is a pretty significant price level. So hopefully that, that opens your eyes a little bit there, David. I hope that helps out in understanding how it affects the underlying equity. But again, don't expect it necessarily to impact the option specifically. Okay, so once more, we're at time, everybody. A big thanks to my friend Barb there in the chat. Please do take a moment and follow Barb and me on X. Kevin Horner, CS, Barb Armstrong, CS. If you like today's segment here, I'd appreciate that thumbs up down below if you don't mind. And of course, More to come from us today. We've got selecting an option strategy up next. Connie Hill will be with you top of the hour. And Wednesday means that tomorrow I'm doing a lot of support stuff, but I will be back with you all on Friday. Trader Talk in today's market begins at market open, 9:30 a.m. Friday. Friday is ETF day. That means simply we are not archiving that one, and that means you better be live if you want to catch it. So I hope to see you then, everybody. Have a great Wednesday, and I'll catch up with you all real soon.